from a summary perspective, last year, just due to COVID, it took a while for the producers to ramp up. They need to hire fracking crews. The supply chain was broken, and the producers were kind of slow to respond at that point. What the industry is kind of looking at now, which is even a little bit more awkward, is because storage is because we don't have the abundance of storage based on the size of the industry that we used to. The producers are becoming the new balancing agents of the industry, and they, quite frankly, haven't necessarily done that before in a short-term environment. They've done it in a medium-term environment and a long-term environment, but they haven't done it in a short-term environment. Right now it feels like the current net supply is supply outpacing demand, but weather and LNG is going to have a big say in what that looks like for the balance of this year. By 2027, in the LNG buildouts, we should start to see demand outpacing supply at that point. And when that happens, there's going to be LNG out there. The power industry isn't going anywhere. We're still going to need heating, gas for heating demand and industrial demand. So we're going to start to see that part of the curve become much more volatile. And like I say, anything below $4 I tend to like out there. And because volatility has shifted from short-term cycles to longer-term cycles too. And I didn't have time to touch on this, but we are seeing all of the expansions, whether it's pipeline or whether it's production, all of that's happening in the South Central area, the Texas, Louisiana, some of it shoots up into Oklahoma, some of the production shoots up into New Mexico, but that part of the industry is really beefing itself up. And what's right in the middle of that whole area is the Henry Hub. So what we could potentially see in the next 4 or 5 years is that the Henry Hub is going to become more connected to LNG and less connected to the rest of the United States. And that's kind of important from the standpoint of if and when that happens, not only is your NYMEX going to be volatile, but your basis or the difference between the Henry Hub and, let's say, Ohio, that number is going to be become much more volatile also. So
just to summarize, the power generation stack is really in a transitional period. Some parts of the U.S. are a little ahead of others, and we can really use those as kind of bellwether on where we think energy prices are going to go during volatile time periods. Because natural gas, the technology behind natural gas plants allows them to be so flexible. A natural gas plant can come online in 10 minutes. A coal plant can take 12 hours. So some of those reasonings are why those plants are going to continue to be important in the stack, and why power prices are going to be tied directly to natural gas prices. So if you're looking at a natural gas curve and you think that's a really good price, the power prices are going to be similarly set, and you should be looking at those concurrently. The other thing is the IRA is really going to increase the rate of the transition, both towards renewables, but also increases in the demand for power. And what this really tells me is that risk management is going to become increasingly important. Looking at these areas where you can have higher highs, lower lows in prices, creates a situation where you really want to understand the grid and get a risk management structure in place to help you manage that.